Today, we're going to talk about a really powerful, but honestly, often misunderstood tool for getting your business insurance costs under control. I'm talking about the workers' compensation deductible. Now, it can save you a ton of money, but if you get it wrong, it can cost you. So let's break down how to make this work for you, not against you. Here's what we're going to cover. First, we'll talk about the premium problem every business is dealing with. Then, we'll get into the nuts and bolts of how these deductibles actually work. After that, we'll look at the potential upsides, the very real risks, and then we're going to solve what I call the experience mod mystery. And trust me, this has a secret that could give you a huge competitive edge. And finally, we'll wrap it all up to help you figure out if this is the right move for your company. Okay, let's just dive right in. For so many businesses, the rising cost of workers' comp insurance feels like this runaway train, right? It's a massive expense, and it can feel like it's completely out of your hands. If you're a business owner, I'm willing to bet the answer to this is a resounding yes. I mean, that constant hunt for ways to bring down your premium is probably what brought you here in the first place. And a deductible plan is one of the most direct ways you can do exactly that. So, how do these things actually work? Okay, here is the single most important thing you need to understand right from the get-go. A workers' comp deductible is nothing like your car insurance. The way the cash flows is basically backwards. And if you miss this one key difference, none of the rest is going to make sense. At its heart, it's a pretty simple trade-off. You, the employer, you're agreeing to take on a piece of the claim cost. And in return for taking on that risk, the insurance company gives you a discount on your premium right up front. Simple as that. Just think about your car insurance for a second. You get in an accident, you pay your $500 deductible, and then the insurance company takes care of the rest. Workers' comp is the complete opposite. The insurer pays for everything first. And why? Well, the law demands it, to make absolutely sure an injured employee gets their medical care and their lost wages right away, without having to wait around for their boss to write a check. So let's walk through it. Say an employee gets hurt. The insurance company steps in and pays 100% of the medical bills, the lost wages, all of it. Then, after they've paid, they turn around and send you, the employer, a bill for what they paid out up to your deductible limit. And then you have to reimburse them. See? Totally backwards. So you might be thinking, why would I ever sign up for that? Well, the thing is, when you manage it correctly, the financial upsides can be huge. It's really a strategic decision to change a fixed cost, your premium, into a variable one that you can actually have some control over. So the most obvious win is that immediate premium reduction. That right there helps your cash flow, because your regular insurance bills are lower. You also get more control and a better look at what your claims are actually costing. But you know what? The biggest advantage might just be psychological. It creates this incredibly powerful reason to focus on workplace safety. When every manager knows that an injury will lead to a direct, out-of-pocket cost for the company, well, safety suddenly becomes a top priority, not just a paragraph in a handbook. Of course, you know what they say, there's no such thing as a free lunch. When you take on a deductible, you are taking on real financial risk. And you have to go into this with your eyes wide open about the potential downsides. Okay, so while your premium is nice and predictable, your reimbursement costs are anything but. You get a bad string of injuries, and all of a sudden you've got these large, unexpected bills that can put a serious strain on your cash flow. And because of that risk, the insurers, they don't just take your word for it. No way. They require you to put up collateral, usually a letter of credit from your bank, to guarantee you can pay. And that collateral can tie up your company's line of credit for years. That's a big deal. This quote from GenCap just says it all. It becomes more of a financial transaction than an insurance transaction. You're really shifting from just transferring risk to actively managing it. It's a whole different ballgame. Okay, this brings us to what might be the most complicated and maybe the most valuable part of this whole thing. It's all about how a deductible plays with your experience modification rate, or what everyone just calls your mod. Think of it as your company's safety report card. So your mod is basically a credit score for safety. It compares your company's actual claims history against the average for other companies just like you in your industry. If your mod is 1.0, you're average. If it's below 1.0, say a 0.85, you get a credit, a nice discount on your premium. But if it's above 1.0, like a 1.20, you pay a debit, a surcharge. So here it is, the million-dollar question. If you pay part of the claim yourself through a deductible, does that lower your mod? You'd think it would, right? But in most states, the answer is no. They use what's called gross reporting, which means the full value of the claim gets reported like your deductible never even existed. But in some states, the rules are different. They allow something called net reporting. And this, right here, is the secret sauce. In these net reporting states, the amount you pay as a deductible is actually subtracted from the total loss before it's reported. So the number that goes into calculating your mod is lower, which can have a massive positive impact on your final score. It's a huge deal. Just look at how powerful this is. We've got two identical companies and a net reporting state. Same work, same real-world safety performance. Company A, no deductible. Its full losses get reported, and it ends up with a mod of 1.12, branding it as a higher risk. Company B uses a deductible. Its reported losses are lower, which drops its mod down to 0.99. All of a sudden, Company B looks safer on paper. It can now win contracts that Company A is literally disqualified from, not because it's actually safer, but because of its insurance strategy. That's a game changer. Okay, so knowing all of that, how do you decide if a deductible plan is the right play for you? Well, it really comes down to the amount of risk you're willing and, more importantly, able to take on. Deductibles really come in two main flavors. You've got your small deductible plans, think $1,000 to $10,000. These are great for most small to medium-sized businesses. They offer a nice little premium credit for a risk that's pretty manageable. And then you have large deductible plans. These are a whole other animal. We're talking $100,000, $500,000, even $1 million per claim. These are only for very large companies with the financial muscle to basically act as their own insurance company for most claims. So who's the perfect fit for one of these huge plans? Well, you're looking at a company with a massive premium to begin with. They need a predictable claims history, an ironclad safety culture, and most of all, a rock-solid balance sheet. These are sophisticated businesses that get it. They understand they are taking on a ton of financial risk, but they're doing it from massive savings and control. So here's the bottom line. Choosing a deductible isn't just an insurance decision. It is a major strategic one. Your very first call should be to find out the reporting rules in your state. Is it gross or net? Your second call should be to your CFO to have a very honest conversation about your company's ability to handle that financial uncertainty. And that leaves us with one last question. And this is one for you to really think about. It's not just about what the balance sheet says you can afford. It's about your culture, your strategy. What is your company's true appetite for risk? Answering that question honestly is the first and most important step to making